Barter. Before money, people used the oldest method in history, barter. You had eggs, I had bread. We traded. No price tags, no coins, no banks, just stuff for stuff. It sounds simple, right? But here's the catch. What if I wanted your bread, but you didn't want my eggs? The whole system depended on both sides wanting something from each other at the same time. And you couldn't store value. You couldn't say, I'll trade this next week, because things spoiled or lost value. That's when people realized they needed something better. A universal something that everyone trusted, anytime, anywhere. Commodity money. So people looked around for things that were naturally valuable. Salt, shells, cocoa beans, animal skins. Things that were rare, durable, and useful. These became the first forms of commodity money. Imagine walking into a market with a bag of salt. Everyone accepted it because they knew it had value, even outside of trade. But again, problems showed up. How many shells does it take to buy a goat? What if a storm floods the beach and suddenly there are tons of shells? Value drops instantly. Commodity money was a step forward. It brought standardization, but it wasn't stable and definitely not convenient. So the world moved to something shinier and harder to fake. Precious metals, gold and silver. They weren't just pretty. They were rare, durable, and nearly impossible to counterfeit. And the best part? Everyone wanted them. They became the global language of trade. You could take a lump of gold anywhere, and someone would be willing to trade you something for it. But now, imagine trying to buy a cup of tea with a chunk of gold. You'd need a scale. You'd need to measure purity, and you'd probably raise some eyebrows. It wasn't practical for everyday stuff. People needed something more usable, with exact values and easy handling. That's when coins entered the picture and changed everything. Minted coins. So gold and silver were valuable, but clunky. You couldn't buy an apple without carrying a chunk of metal and a scale to weigh it. Governments saw the problem and said, what if we turn this metal into coins with fixed weight, shape, and value? Boom. Minted coins were born. Suddenly, you didn't need to weigh anything. A silver coin was a silver coin. People recognized it, trusted it, and used it. It made trade faster, easier, and more official. But there was a catch. Coins were still heavy to carry in large amounts. And if you had a bag full of them, thieves were all ears. So the next breakthrough had to be lighter and smarter. Paper money. Instead of carrying heavy coins, people started leaving their gold and silver in banks. In return, they received a paper note, a promise that the bank held that value for them. This was revolutionary. Paper was light, portable, and easy to count. Suddenly, you could carry hundreds in your pocket without clinking like a pirate. But paper introduced a new risk. It wasn't valuable on its own. Its worth came from trust. Trust in the bank. Trust in the government. If the system failed, your money could vanish overnight. Still, paper money made trade smoother, travel easier, and value more mobile. It was a leap forward, but one built on belief. Traditional banking. As money evolved, so did the need to manage it. That's where traditional banks stepped in. They became the gatekeepers of your money. You deposited cash, received a passbook, and visited your branch for everything. Saving, withdrawing, sending money. Banks made storing money safer, but they also brought you bureaucracy. Want to transfer funds? Fill a form? Want to update something? Stand in line. And if it's Sunday or a holiday? Sorry, come back later. Banks were secure, but painfully slow. And in a world that was speeding up, people began asking, why can't money move as fast as life does? Checks and promissory notes. Carrying stacks of paper money wasn't always safe, so people came up with something smarter: checks. Instead of handing over cash, you just signed a piece of paper. The person could take it to a bank and get the money later. This made big payments safer and classier. You could buy land, goods, or services with a signature, but checks weren't perfect. They could bounce, they could be forged, they could get lost, and clearing them took time, sometimes days. Checks made money more flexible, but they still relied on paper, trust, and old-school systems. The world was getting faster, and something plastic was about to change everything: credit and debit cards. Enter credit and debit cards, a tiny piece of plastic that flipped the game. No more carrying bills or checks. Just swipe or insert your card, and boom, payment complete. Debit cards pulled money from your account. Credit cards let you buy now, pay later. Convenient, fast, widely accepted. Shopping, travel, online orders all became easier, but there was still a catch. You needed machines to read them, and they were tied to the traditional banking system. We were going digital, but we weren't there yet. That's where the internet stepped in. Online banking. With the rise of the internet, money officially went online. Banks launched websites. You could now transfer money, pay bills, and check balances, all from home. No lines, no paper forms, no waiting for a teller. It was freedom. Money moved at the speed of your Wi-Fi. But even then, it still relied on banks, and many people didn't trust doing it all online. Still, the convenience was addictive, and soon, we didn't even need banks' websites. Money was about to go mobile. Digital payments. Now we're in a world where a tap or scan is all it takes. Apps like PayPal, Venmo, Apple Pay, and Google Pay let you send money in seconds. Split a bill, buy a snack, tip your barber, all from your phone. No cash, no cards, no delays. It's fast, clean, and super easy. But here's the twist. All these apps are owned by private companies. They can block your transactions or freeze your funds. You're still not fully in control. So a question rose. What if we could have digital money that no one could block? Virtual currency. Before crypto, games gave us a taste of digital money. Gold coins, diamonds, in-game tokens, things you bought with real money, but only used inside a virtual world. We started believing in digital value, even if it didn't exist physically. But here's the issue. You didn't own that money. The game company did. They could ban your account or delete your balance anytime. Virtual currency made us comfortable with online value, but it wasn't truly ours. Something bigger was coming. Cryptocurrency. In 2009, Bitcoin changed everything. A currency with no bank, no borders, and no permission required. It was run by code and owned by the people. You could send money anywhere, anytime, without needing anyone's approval. Every transaction was recorded on a public blockchain. No fakes, no censorship. But it wasn't perfect. Prices were volatile. It was hard to understand, and governments didn't like losing control. Still, for the first time ever, money became truly free. Blockchain and DeFi. Then came the real revolution. Not just the coins, but the tech behind them. Blockchain wasn't just for money. It could run code, execute contracts, and replace entire industries. Enter DeFi, decentralized finance, loans, trading, insurance, all without banks. Just code doing what people used to. No middlemen, no waiting, no permission. You and the system. That's it. Finance was no longer locked behind institutions. It was open source, unstoppable, and global. Stablecoins and CBDCs. Crypto was powerful, but unstable. So came the stablecoins, like USDT or USDC. They were digital tokens tied to real currencies like the dollar. No wild price swings, but still fast and borderless. And then, governments stepped in. They introduced CBDCs, central bank digital currencies, like the digital dollar or digital yuan. Official, regulated, trackable. Now we have two worlds: the open, decentralized freedom of crypto and the structured, government-backed control of CBDCs. Which one wins? Maybe both. Because money isn't just paper, it's what we believe in. If you enjoyed this journey, smash that like button, hit subscribe, and turn on the bell, because we've got way more mind-blowing content coming your way.